Good morning. It's Jeffrey Cohen, investment advisor representative and founder of U.S. Advanced Computing Infrastructures, Inc. You also may know us as Chicago Quantum. We're going to talk today about the stock market. We're going to talk about the Federal Reserve and the Federal Open Market Committee, how they're having their meeting today, and they're going to decide on whether they change interest rates. Um, we're going to talk through the model run. I'm actually going to flash up a little bit too, a sample report. So we reduced the price of our run from $1,000 to 500 per day per run to now $100. The reason we do that is we want to make this available to people, to companies, to portfolio managers, high net worth individuals. $100 to get a full assessment of the whole stock market seems like a steal, especially when it's a little different than everybody else. It's a modified Sharpe ratio. It's designed to run on a quantum computer. It has a different outcome, but it's also very comprehensive on the market. And what's funny is last night we ran it. Here it is. And we're going to have and by the way, I subscribe to Bloomberg. I like Bloomberg. Why not? But it's interesting information. The model gives you a real take on the market. And what I'll tell you is this: if I go to the very bottom, so I do some additional searching of the centillion plus portfolio possibilities out there, and the only ran for 6 minutes, right, each, but we get the same answer. We get 5 stocks that are totally risky. Oh my God, new economy. 29 ticks of edge is higher than we've seen in a few weeks. So the market right now, this morning, is risk on. It's 5 what I'll call e-commerce stocks. That's not normal. I mean, we don't call them e-commerce anymore. That's from like the 2000s. But it is. It's new stuff. It's lending to subprime borrowers. It's tech. The market says go. The market says go crazy. And in fact, the other things that it's been picking in its favorite portfolios, I'm going to show you what you would pay $100 for. Your top 5 stocks, you would switch HLGN with Carvana. So Carvana, not only do they sell used cars, but they lend you the money. And then you see right here, you're still at 29 ticks, rounding up, is TNA. TNA is a 3 times small cap bull bet. It's an ETF that actually has tremendously attractive covariance with a lot of other stocks. And so when you add it to a portfolio, you got your 6th stock. You replaced Carvana with TNA, so you took out the used auto company. This is a very interesting thing. So what this says is, if you have money at 5% of your portfolio, and you want to put it in for 20 trading days, figure a month, you'd buy this. And why would you buy it? You'd buy it because it's tremendously risky. It's aggressive. If the market goes up, these things scream higher. They scream higher. But with less risk than you would typically pay for that higher scream. Why are you getting high return? Why does the model say, give me those high returns? Well, part of it is the variance of the S&P 500 continues to drop. It was 2.4 not long ago. It was 3.6. That's 2.2. The markets are going up. The S&P 500 compared to a year ago is 15.33% higher. Now, your risk-free rate moving forward is 5.5%. So you can get 5.5% for 6 months. Great. That's actually a really good deal. No risk. It's like the perfect CD. You're buying treasuries. But you would have earned 15% in the S&P 500. You would have broken even effectively on a Russell 2000 or the small caps. I got my eye on the other screen there. It's interesting. And your QQQ is up 27.5%. So tech has gone through the roof. Now, it doesn't much make sense that tech would be so much higher because normally tech is sensitive to interest rates. If interest rates go up, tech goes down. Why is that? Today's tech is a little different than yesterday's tech. So yesterday's tech were growth stocks. They were stocks that didn't make a big profit, but you were betting on growth in the future. Amazon, when they were still making their tabletop, their door tables. Microsoft, when Bill Gates decided to make an operating system for a PC. Not today. So normally interest rates make the value of future profits lower. So just by definition, a company that's going to make a profit in 5 years isn't worth as much now. Okay? That's not really what tech looks like today. Tech today looks profitable. Looks like it's squeezing businesses, growing with inflation. That's crazy. So whatever that is, it's okay. The expected market return over and above the risk-free rate of return of 5.5 is 8.25. 8.25 is high. I remember when the market was dropping, this number was down to 1.2. 1.2% expected market return for a year. The market was crying in pain, and now 8.25 plus 5.5, that's like a 14% return. Why wouldn't you be in stocks if the model is right? Now, the model looked at 3,020 stocks that passed data validation. Here's the other thing. The all-stock variance of 3,020 stocks all held evenly. All held with a weighting of 1 over 3,020 is 4.07 times 10 to the negative 5. So that number is actually very low. Jeffrey, how low is it? Stock price variance. 4.1, you're almost closer to 4.0 at this point. And if you look, that number should be, it was 6. It was 6 in May, and now it's 4. It's down 33%. That's crazy. I'm just telling you that's crazy. S&P 500 is down to 2.2. It was 3.8 and 3.5. Is it still 2.2? Yeah, it's 2.2, but at the lower end of 2.2. So let's look at the best CQ&S scores. So typically, you see the S&P 500 like here. That's normally where you would see, oh, I see the big 3 ETFs. QQQ, SPY, IWM. And then you know that it makes sense because very few stocks normally have a better risk return than all the stocks. Not today. You keep scrolling down the list. You got TNA, which is your 3 times bull. You got Carvana, Cardlytics. By the way, Unity, they're having an issue now. They're in the digital application monetization business, and they also have a great engine for 3D. Rackspace. I can't imagine. Marathon Digital Holdings, Q-Rate Retail. These are all a better risk return than the S&P 500. In fact, all of these are. Not normal. Okay? Risk on. Risk to the moon is what our model says. It's crazy. I've never really seen this before. The market is managing somehow the volatility of individual stocks and driving them lower and lower and lower so that they're approaching the variance of the S&P 500. It's still double. It's still almost double. but it's lower. And on an absolute basis, it's lower. Relatively looks good. Now, your worst stocks, your garbage, your stuff to throw out, your stuff to avoid, your stuff to short, names you're familiar with, a lot of these are very, very small cap. And so I'm going to reverse sort. This is the spreadsheet with the score on every stock. So we look at a firm holdings, an expected return based on their beta value, and the stock market return that we've had is 35%. That's crazy. The model is predicting that 35%. I mean, I want to vomit. That's like a really, really high return. So you look at all these stocks, it says, look, if you're willing to hold your nose and take the risk, your expected return is super high. That's because they have a high beta and the market's going up. Now let's look at the worst stocks. The worst stocks have a very small return, 7, 9, 14, 6, 14, 11, 12, 11, 14, 10, 10. Okay, so they have a very low beta, but they have a high variance. So these stocks are going up and down with very little gain. But let's take a look for a minute. Are they the big money stocks? And my guess is that they're not. Yeah, so $1 million market cap, 3.5 million, 8 million. Of course they're volatile. I could move the market. $900,000, I could buy the whole damn company. Sayata Mobile. So the point is, you can move the market. There's only one stock worth more than $1 billion here. Let's fold it up. And so it's fine. It makes sense. Biohaven, million. No, billion. I'm sorry, billion. These are millions. But where else? So right now you're in a small cap, crazy time. That's how I look at this. So what stock is 5 billion? It's Excel Service Holdings. I don't even know who that is. And so is now the time to buy risk, to buy heavy risk with a low variance? Maybe. The model says yes. The market opened higher. It's just so interesting, right? So now what if you wanted the most risk with the least, the most risk with the least return? You would short some of this. Now you might say, you know what, Jeff, I can't short this stuff because there's not enough market cap. Okay? There's not. I need better. I need at least a $10 billion market cap. So you might go in and say, okay, give me all the stocks that are greater than 10 billion. What are they? Well, you got to scroll for a long time because large cap tends to be less manipulated, less volatile. The worst high cap stock is Super Microcomputers, SMCI. SMCI has an expected return of 17, pretty high variance, pays a dividend, does it? No dividend. It's worth 13 billion. Okay, it looks like it's a beta of 1.36, maybe. So that's what this model is really saying. It's saying that these small caps are really risky. Maybe you avoid them, maybe you don't. Now let's look at the best ones. And what I'm going to do here just to help you. So what I'm trying to do is show you how you might use our model, because it sure is interesting. I do this a lot, right? I actually look and I say, okay, where are we? Let's freeze the rows, freeze the columns. So, of course, you're not going to see so I put in a few ETFs in there just to It's like putting some spice in the stew. Only one of your best picks is worth more than 10 billion, which is interesting. And that's Unity Software. And Unity Software, which bought Iron Source, is a company in transition. It's really in trouble. But if they make it, the model says this is a stock that you want to take the risk on. Unity Software individually over the past year has been pretty flat, up and down. So if you're a day trader, that's fine. But if you bought it a year ago at 33 and a quarter and now it's 33.62, you didn't make or lose anything. You probably sweated a lot. But this company loses money. It's at the cornerstone though. This company and like Digital Turbine, they are at the cornerstone of gaming. It'll take me a lot longer to explain that. And by the way, the other one that's at the cornerstone of gaming is AppLovin. And there's others, there's gaming companies, right? But AppLovin does monetization. Digital Turbine controls the downloads onto your phone. They own that piece of software. And so they allow this one click. We do not have a position in Digital Turbine. We do not have a position in Unity. So the model likes Unity. What else? The model likes Block, SQ. Why would the model like Block, SQ? Well, I don't know. What does SQ do? I used to know. By the way, I'm kind of kidding around. Of course I know what SQ does. But let's take a look. So Block, over the past year, has also been, it started at 56, it's down to 49, it's been up and down. They do the thing, the square, where you would swipe your credit card. So like a taxi driver doesn't want to pay the 9% tax that their monitor, their system, their terminal charges in the taxi. So they have a little square. If I was going to do business out on the street and get people to buy my runs, I'd have a square. I want people just to swipe. Now, people can buy our services on our website and use a service like Square. So let's say you wanted to buy a $100 upfront. All right, fine. Number of stocks, give me 10. My name is Jeffrey. My objective is to make money. Just to get it in there. Add to cart. $100. See that? PayPal, Visa, MasterCard, Amex, Discover. But if I go to checkout, I have to fill all this out. I'm not going to. But so I use PayPal. I don't use Square. Other people use Square. So that's a good business, right? That's actually really good. That's e-commerce. That's future. That's payments. So there's another one the model likes. And then you come here at Cloudflare, and that's another kind of e-commerce. Coinbase, e-commerce with Bitcoin. Caesars is gambling. Integris Marvel Tech, I don't know. Bill Holdings, I don't know. So you get a feeling that the model is attracted to smaller market cap companies that have very little price risk and an extraordinary potential for return based on their beta. Look at those betas. 2 and 3. Let's do a quick conditional highlight on those betas. Greater than 2.5. So they have more than 250% of the systematic risk of the S&P 500. You can see a lot of them at the top do. The model loves these high beta stocks with low risk. That makes sense though, because we're offsetting high return, high expected return with low risk. So if the market's going up, this is where you're going to make your money. And so it's good to know this. And what I find is whenever there's a glimmer of hope in the market, these stocks tend to go up. Some days they go up 5 to 10%. It's easy to pay for $100 run that way because now at least you know. And if the market's dropping, you know where it's dropping and you know what to stay away from. So again, right, the model is pretty risk on right now. But let's get a feeling for where we are. So there are positive skew stocks, 33 of them. These are stocks that have consistently had a positive skew. There are negative skew stocks, and there's a lot of them at 30. So 1% of the market has an anomalous trading behavior around skewness to the positive, and 1%, because it's 30 compared to 3,020, with negative skewness. So if you want to bet on skewness, you can get these. The most negative skew stock is Biohaven, BHVN. By the way, I don't know anything about Biohaven, don't have a position. Let's take a look. BHVN, Biohaven. Biotech Healthcare. So when you look at it, it's a negative skew. It sure seems to go up a lot more than it goes down because it started the year at 7 and it's at 17. So negative skew has meant that it's tended to go up. Positive, more positive than negative. Now we look at leptokurtic and platykurtic. So you see there's not many of those. There's like a 20 in total. So it's like a half or a quarter of a percent of stocks have a leptokurtic or platykurtic distribution, which if you look at PNM Resources, which is New Mexico's public utility, I actually wrote this up on my website because people were like, Jeff, you can talk about like leptokurtic stocks, but maybe you shouldn't. Maybe this isn't that interesting. And so I'm like, no, it's really interesting. So PNM Resources, it's gone down a little. By the way, I looked yesterday, it moved less than 1%. So the daily price changes are very, very, very small, within 1.5%. But there's one or two big moves. So if we look, it's actually fallen more than 1.5%. 1.5% is nothing in this market, right? So it fell 4 times, and it rose 4 times, and the rest of the times it was right in the middle. That's a great leptokurtic view. So what do I care? I care because this stock is generally never going to move. But when it does, it moves a lot. And you can see it doesn't move, but when it moves a lot. It had one big move where it fell like 5.5%. Okay. So that's what you're buying. You're buying a list of stocks that has that kind of odd behavior that it just doesn't move. But when it moves a lot. And I can't tell you if it's going to go up or down, but I can tell you that it's going to surprise more often than it should with a normal distribution. Oh, look, the stock's up 1/2 of 1%, 0.6. Great. Normal day for PNM Resources. But what happened? Why did it crash between May 8th and May 15th? I don't know. But that's the way you use the model. It's interesting, right? So what else did I see today? The other thing to talk about is the negative beta stocks. Chicago Quantum is the home of the negative beta stock list, right? So the Atlanta Braves, BATRX, is a negative beta stock. Pfizer continues to be negative beta, continues to buck the trend. When the market goes up, it goes down. When the market goes down, it goes up. U-Haul is 3 times negative beta. U-Haul. Now, no surprise, the dollar has a negative beta. When the dollar goes up, stocks go down and vice versa because of an underlying fundamental issue. If the dollar is stronger than a company that has overseas earnings and brings them back, repatriates the earnings, they're worth less. All right, so I get that. The second place we see a lot of negative beta is on VIX. VIX is volatility. We report VIX, but not VIX. We report variance, which would be not implied volatility, but actual volatility. We prefer to look at actuals. The actuals are that volatility has dropped almost 50% over the past year. That's great for stocks. Volatility goes down, stocks go up. What this says is when volatility goes up, stocks go down. It's not that it causes them to go down, but they just do. So if we look at the VIX, so I've been looking at the Chicago Mercantile Exchange, has a VIX data point. I probably should be paying for CME data, but it's hard for me to justify that because I don't trade volatility. But you take a look, and the VIX is down to 14, 13.99. You would say 13 handles. That's really good for stocks because that says, hey guys, I can buy volatility protection. I can buy downside protection. It's cheaper. I'm safer. I feel safer because the VIX is low. So negative beta, when the VIX drops, it should be good for stocks. So let's take a look at where we are with the market. And I'll keep talking about individual names. I know people like that. I'll do that. I'm not going to be self-serving though. This is not a pump and dump channel. So we look at stocks, and right now you can see for the day, things are up. Small caps are up 0.6. The Nasdaq's up 0.1. S&P's up 0.2. You can see the global yields in the U.S. is 4.33. That's pretty high for a 10-year bond, 10-year note, U.S. Treasury note. I can't believe the 1 year is 5.44. Oil's over 90 for U.S. Natural gas still isn't moving. Treasuries are flat. Maybe they're up a skosh, which means yields are down a skosh, but it's not much. So the Federal Open Market Committee is going to meet today. Stocks actually were driven much higher at the open, but then have come back down. So we look at it this way as well. Stocks were higher at the open, but came back down. The S&P 500 has actually been just up and flat. It just generally doesn't move. The futures, we look at a bunch of futures. I mean, we could go back to our negative beta stocks. Summit Therapeutics is slightly negative beta. The places where you see high negative beta stocks, though, Chesapeake Utilities, I mean, they have some issues, company-specific issues. But let's take one last look. If you want to bet against the market and you truly want a negative beta in your portfolio, here are some ultra short QQQ, 3 times leverage, ultra short small cap bear stocks, right? So TNA, this is the opposite, TZA. And you can buy, at least for the short term, some aggressively negative beta. So if you want to bet on a downturn, you add some of this to your portfolio, and if the market goes down, it goes up. So that's great. So you could have stocks that's negative beta, like you can buy U-Haul or Fiserv or the Atlanta Braves, or you can buy VIX, right? The VIX, when the VIX goes up, stocks go down, vice versa. Stocks go down, VIX is up. It's not a causality, it's a correlation. It's light. The dollar, it's a 25% negative beta. So if the dollar goes up 1%, you'd expect there's like a 1/4 point drag on company valuations. And then you can just go ahead, go crazy, and bet short on the market. And there's other ETFs. These are large. That's why I picked them. SQQQ and TZA are a way to bet against the market. So if we look at the futures, you see crude oil here is at 89.84, so still at 90. You can see bonds look a little green. Bonds, notes, U.S. sovereign debt. Copper's up 3 cents. I take all this with a grain of salt because they say the VIX is 15. But if you look at the CME, the VIX is 13.99. I trust the CME's data, even though it might be a bit delayed. We look at crypto. Bitcoin's flat, but Bitcoin has really recovered. Bitcoin was under 20 grand at the beginning of the year, and it really screamed higher, it came lower, and has been coming up again. A lot of volatility on Bitcoin. I mean, people like that, I guess. So we'll stay with that as a concept. And then let's take a look at any particular stock. So Intel's down almost 3%. There's a better way to look at that. You look at a bubble chart. You look at any index. You look at market cap over 2 billion. So you get a bunch of the anomalies out of the way, and you see what's dropped. Getty Images, some others. By the way, I turned advertising back on for all my websites so that they get a little bit of money when I use them. Textron's up. GOL Airline, South American Airline is up. International Flavors and Fragrances is up. But I don't know most of these, right? But Intel's down, ARM is down, Chewy is down. Okay, most of the things are right in the middle, right in the range. Now, that's interesting. Apple's down 0.2%. That's a big drag on the market. Alphabet's down 1%. Toyota's down. Now, I would have thought the strike would have helped them. Mitsubishi Finance is down. No, they take a lot of asymmetric risks. They lend a lot of money to corporations. I've seen that name in a lot of books for a lot of stonks where they do the corporate financing. So if corporate finance defaults go up, I would expect Mitsubishi, MUFG to go down. Eli Lilly, that's been a high flyer. That's lower. So I wonder what's going to happen with the FOMC. The CME has a bet. FedWatch tool. It just tracks in 3 hours and 6 minutes. What are the likelihoods? 99% that the Fed will keep it the same, and a 1% chance that they're going to raise a quarter point. The funny part is that I, Jeffrey Cohen, on behalf of U.S. Advanced Computing Infrastructures, Inc., I believe that there is a much higher than 1% chance that they're going to raise a quarter point. I think they almost have to show commitment. So I think that's going to be a huge surprise. The market is going to go gangbusters crazy. It's going to say, oh my God, they raised a quarter point. I was wrong. I don't know what to do. Stocks are going to go up and down a lot. And nothing really changes. But at least that now you see it. This is CME Group. Now, we could go out to other periods, though. Let's look at November. November 1st. They're calling a 25-point rise, 29% chance of a 25 basis point rise in November. We look at December, they're calling a 35% chance of a quarter point and a 5% chance of a half a point rise. So why would you do it? Why would you wait? I wouldn't wait. I'm the Fed, I'd do it right now. Get it out of the way. It doesn't help to have an interest rate increase in the bank. Put it on the table where it could actually start to reduce inflation. So you take a look at the stocks again, you can see we're up 0.6 for the Russell, up 0.1 for NASDAQ, up 0.2 for the S&P 500. You're still at that 4.33 for the 10-year. That's interesting. It looks like it's trying to fall. And then what else do we have open? So one other test that we do. We take all the stocks that we have. We look at all the market caps and we sum them up. And you're at 51.3 trillion. Now that number should have some meaning for you. 51.3 trillion. Let me explain. So if you go to the Chicago Quantum page and you look at the key market drivers, top stock market drivers, and you look at momentum. One of the things we look at is total equity stock market capitalization, and it was 51.4. Now it's 51.3. So it's down 0.1 trillion. Now, 2, 3 weeks ago, this thing was moving fast. It's not moving right now. So I would say you got to think about that. The stock market is showing some movement, but in fact, the market itself is not. The underlying stocks are not changing in value. So it's all chop and no movement. Look at it over the month. Look at it over 5 days. Look at that movement. That feels like a lot of movement, but what's actually happening is it's ending the days where it started. It's not moving. It's not moving. So what does that mean? It's like day traders come in and they make a move in the morning, and then in the afternoon it goes back. It's not moving. And so if you think about it, the way like you would build a cryptocurrency, right, is let's say you have a gazillion coins, right? Centillion coins, right? 10 to the 300th power to 10 to the 600th power coins. And each one is worth 1 trillionth of a penny. And you're like, hey, if we can get this thing up to a penny, we make it. Now, if you're buying and selling at a quarter point, quarter penny, half a penny, a full penny, you're making money. It feels good. But look at the total valuation of a centillion coins. If it hits a penny, you're 1/100th of a centillion. You own the whole world, right? Now, the truth is, you go to sell a few of them, and the price is going to drop. But at that moment, that market cap, its market capitalization is based on the last trade of every stock at 4 p.m. You can move that. You could paint the tape. You could ladder. You could affect the price that a stock closes in the last minute, and you could change it. You could change the trajectory of a stock. And people do that. That's like a thing, right? And so it didn't happen. It hasn't happened now for a week. No one is touching stock valuations. They're just not moving. It's right pocket, left pocket. It's rotation. This market is rotating. It's not moving. So now I ask you this. You're putting your money in the stock market and you're hoping for a big return. You're getting our stock model and you're seeing that there's aggressive risk-on behavior because the expected market return is so high. But it just isn't moving yesterday. It didn't move yesterday. It didn't move last week. Now, the fact that it's not moving, it's like it's coiling for a strike. It's consolidating. It's getting ready to move. Can we see that in the chart? Is this a coil? Is this a snake coiling and ready to strike? Let's look not at an hourly chart. Let's look at a weekly chart. A weekly chart on the S&P 500 should go back like 5 years. Might take a minute. I've been having some trouble with Yahoo Finance. It's very, very slow these days. I don't know. There it is. I know. And there it is. So the question is, right, it went up for years, then it dropped. This is 2020. It went up, it dropped, 2008. That's what we're kind of expecting now with interest rates going up. It's gone up. It's really gone kind of flat since 4,600. That's when we sold most of our positions. It went up and it hit 4,600 again. So the question is, if we look at the market right here, I'm going to doodle it. If we look at the market right here, it sure looks like it's getting ready. That's an old cup and handle. That's a cup and handle. Goes up, comes down. It's kind of slowly working its way. It almost looks like an upside down head and shoulders. Almost. If I was a suspicious man, I would say that. Or what do they call it? If I was a superstitious man, I would say that this whole rise up has been because there was a capitulation that didn't work. So now we're up high. I'm just not sure. Where are we here? Is this poised to strike higher? Is this a bull flag? On the weekly chart, this could be a bull flag, which means market's going to go higher. Our model would say market's going to go higher. It's just hard to know, right? It's a cup and handle. Now you look at the daily, because a lot of people don't like to look at the weekly. And by the way, I'm looking at this now, and your e-commerce, your tech stocks, I don't know what the indices are doing, but you take a look. Apple's down a point, Microsoft's down 0.4, Google's down, I mean a point, I mean a percent. Google's down over 1%, Amazon's down an eighth, Meta's down nothing. Walmart's up, Netflix is down, Disney is up, Shopify's down, PayPal's down, boom, boom, boom. So markets are lower, right? The e-commerce, the online business is lower. That's not good for our model. Our model says those guys should be screaming higher. Banks look good. I can't imagine that the banks are happy right now. Interest rates are going up. They're losing, I was going to say something inappropriate, but I won't. They're losing their book value. They're losing their book value because the treasuries that they invested in with all that investor money, they're worthless. So they're all like in really big trouble. But they're waiting on higher interest rates, and they're hoping that they can lend out faster than they take in deposits, that their net interest income will go up because they lend expensive and they borrow from depositors cheap. I don't know, I think it's crazy. So you see the 10 years down almost 4 basis points. The 30 years down 2 basis points. The 5 years down 4 basis points. The 2 years down 5 basis points. So interest rates are dropping into the Fed. Longer rates are dropping. I wonder, because take a look, the 13-week is up a basis point. I wonder if people are thinking that they might raise, even though there's only a 1% chance. Don't know. So what's my takeaway here? The S&P 500 might be coiling to strike. That's interesting. By the way, you like diamonds? Diamond prices are falling. If you like diamonds, buy when the price goes down. What else is going on Bloomberg markets? Again, I love Bloomberg markets, and I had my earphones in. I was listening to Bloomberg this morning. They were talking about, are we there yet? Are we there yet? Interest rates, are we there yet? Are we there yet? Everyone says, nah, maybe not. Maybe we're not there yet. Hawkish hold. We're not there yet. So interesting. Why are stocks going up if we're in a hawkish hold? And oil is up. Oil can go to $100. Gasoline. How are we doing with gasoline? I don't have a good data point. I don't want to go to the CME. I should use the CME. I should now subscribe to the CME, get all their data. But you look at gasoline prices and they've dropped. So the question is, why was gasoline higher September 14 than it is now when the price of oil has gone through the roof? And I think that's just funny math right now. So who are we following? Got a couple of quantum stocks in here. I like this. This is like an interesting I clicked on change percentage. Oh my. Signature Bank, whatever's left of it, is not doing so hot. Natural gas down. IonQ, the most valuable quantum corporation, is down, and that's been down a fair bit. Apple's down, Google's down, Square is down, Matador Holdings is down. That's shale play. Qubits, D-Wave is down. I might have to buy some more of that. I like D-Wave. I need to start running my job on their system again. There's a lot of stuff that I look at. By the way, the one stock that I think is poised for a recovery is Digital Turbine. We do not have a position on Digital Turbine. We're not long, we're not short, we have no calls, we have no puts, we got nothing, right? But we're watching it. This thing has coasted. It dropped from 14 to 8. It's then coasted back down to below 7. The problem with Digital Turbine is it's an app that comes loaded on your cell phone. It's good in terms of installing apps, but I don't find that installing apps takes me very long, or is that big of a deal. It's not an impediment. And so they're trying to make it easier for people to install apps. I don't know. It's not that interesting. The business is not that interesting to me, but it's kind of in this, digital monetization, digital advertising space. So it could be something there. The company's not really worth much on a tangible basis. They have more debt than assets. So they have a negative tangible book value. So you kind of have to believe that they're going to turn the ship around. I don't know that I do. But I'll tell you that it's an interesting stock anyway. So let's take a look at who's moving here. This is Trending Tickers by Yahoo. This is not Chicago Quantum. By the way, I hope you're enjoying the video. This is cool. I don't mind sharing all this stuff with you. If you wanted to drop a comment, drop a chat, ask me anything, or just post your tickers, I could talk about them. I look here, and Bird Global is one of the stocks. It's so interesting. They do the little bicycles that you rent. They run that as a franchise business. You become a franchisee, you buy a bunch of bicycles, you buy their app, they take a cut. Instacart down slightly. Instacart, was a new IPO. It's interesting. Intel's down, but Intel's not cheap. What's gone up? I don't know a lot of these companies. Metamaterials I used to know. Oh, Pinterest. Now, Pinterest is up 6%. Pinterest has worked really hard to get people to use it as a platform, and they bought back a lot of stock. I'm not even sure they make a profit. This is a new IPO, KVYO. They compete in the buy now, pay later space. So Pinterest, you're never really supposed to use Yahoo financials. You're supposed to go to the SEC filing and look at the quarterly, and I know that. But let's just take a quick look. They're making any money? Excuse me. No, losing money. Excuse me. Losing money. It's the truth. They made money in one quarter recently. Do it on an annual basis. They made money in 2021, and that was it. And that was it. They lose money. So, Pinterest buys back the stock, loses the money. Where's the cash flow on this thing? Quarterly cash flow. Operating cash flow. Not bad. Look at that. Financing cash flow. Common stock. They bought back $500 million of their common stock. End cash position, $1.1 billion. So they just It burned a hole in their pocket, right? They raised the money and they used it to buy back the stock. It's fine. But if you did it once, you'll do it twice, right? And you'll buy back the stock again. And I don't know why they're doing that. That seems weird to me. Now the stock's up 5%, so maybe they're buying some back right now. Don't know, but they only have $1 billion left and they lose money every year. So how much? Now it says operating cash flow versus investing versus financing, but let's take a look. Are they making money per year? No. They lose money, so they need to keep cash so they don't lose all the money and then have to go bankrupt. Okay, that's Pinterest. So and maybe I'm just an old stick in the mud, but I look at something like Pinterest and I think, please hold on to your money. Don't buy back all the stocks because you'll need the money. Interest rates are high. Money is worth more than it was a year ago. What are the top losers in the market? That's so funny. I'm turning that off. Why would they say sucks on Bloomberg? I don't know. Keep the language clean, buddies. Eastern Bank Shares is down 9%. Okay. Intap, I've heard of. Getty Images, I'm not sure why Getty Images is worth less. WeWork, I understand why. It's a tough model. Stock was as high as 140. It's down to $4. We do need a place to work, though. So that could be an interesting stock to look at. That's it. So there's one stock interesting there, which is WeWork. Take a look at WeWork over a month, and you can see it's dropped as low as 262 up to 5, so it doubled on a lot of volume. Looks like a meme to me. Looks like manipulation. Looks like a play, day trading play. But I'm open to those kind of things. Let's see what we can learn. Okay, how are we doing again on interest rates? How are the bonds? So they're down, right? So you see that down 4 basis points, down 5 basis points, down 3 basis points. Whew. Okay. Not sure why you think that. Top stock gainers. Where are we at? CMAX. That's interesting. Mexican cement company. That's interesting. Goodyear Tire and Rubber. Western Digital. I mean, maybe people are spending more on tires. I don't know. It's probably worth a look. International Flavors and Fragrances you heard about before on the call. That was looking up. Pinterest is looking up. NatWest is looking up. Lloyd's Banking Group is up. That's interesting. Okay, I don't know. But Goodyear's up. What's up with Goodyear? It's worth under $4 billion. They are a supplier to the automotive industry. It was at 11, it's now 13, so it's up like 20% for the year. I don't know. They make money? Goodyear? You make money, Goodyear? Annual income statement. Net income. They make a little bit of money last 2 years. What's interesting is trailing 12 months, they made $5 million. Who the hell makes $5 million on a $21 billion company? I don't know. Has the cash flow. Why is Goodyear not making any money? That's so stupid. They generate reasonably good cash flow. They're investing. They're generating cash from their financing. Oh, they're issuing long-term debt. So they're borrowing money. and they're making money, but they're investing it in CapEx. Okay, so Goodyear is a story of a CapEx investment into their business. It's worth a story because I don't think tires are going anywhere. I think we're going to have tires for a long time. Paper, same thing. How we doing on international paper, right? Basically, it's flat. International paper. How do they score? There it is. They scored 976. They're right in the middle. They're worth $11.7 billion. They pay a 5.5% dividend. Ooh, we're going to make 14% next year. Risk looks pretty low. I mean, it's not a great stock to hold only as one stock, but it's got a little bit of a higher variance, but not bad. Not bad at all. So I would say international paper worth some homework. Let's look at Goodyear Tire and Rubber. 1341, middle of the pack. Expected to earn 19%. Variance is much higher. So compared to international paper, Goodyear's variance is like 25 times higher. Does not pay a dividend. So for Goodyear, that one's a little tougher to make a call on. Right? International paper almost looks good as they're investing money, they're whatever, right? So what's this? Matching stocks. These are most actives. More than 5 million shares. They moving? ARM Holdings. So ARM Holdings has come down. You can see that. It's a 52-week range is down. It's a new IPO. Didn't do so hot. IonQ has been falling like an old person who's lost their sense of balance and doesn't want to use a walker. Just saying. Falling a lot. How's IonQ look in our model? 128. It is a small cap that has a very high beta, so it's a 26% expected return. It has a tremendously high variance, so this thing is going to bounce around. You should know that. Very, very risky, but a high beta. It's not your best stock, but the model actually doesn't mind it if you want to put some money to work for risk. Talked about ARM. That's interesting. We talked about IonQ. We're not talking fundamental analysis because you could look at IonQ. It's worth about $3.3 billion and say, is it worth it? I know a guy out there named Brian who used to go by Luke Skywalker, and that was his handle. He was Luke Skywalker or Brian Skywalker or something, or I'm a ninja guy. He's actually a retired naval officer, I believe, who lives in the Philippines. I love the guy. He's a good guy. But he's talking about IonQ as being not having the technology that might work so well. I don't know how he would know, but he felt really strongly about it. So, all right. So take a look at the stocks that we're following. Oh, it's frozen. Sorry. This is my LinkedIn. If you guys want to reach out to me, I'm Jeffrey Cohen, entrepreneur, IT services executive, and investment advisor. Love to hear from you. Bloomberg Markets, how we doing? I don't know how we're doing. This isn't helpful. Nothing on Twitter we're talking about. We haven't updated our data yet. We're going to close down LinkedIn. We'll close down Bloomberg. What else we got here? What else is worth talking about? Otherwise, we're just going to wrap up the call. Talked about IonQ, right? Being a high risk, potentially high return. International paper could be an interesting play. You know who also could be an interesting play? Let's take a quick look. Is Cleveland-Cliffs. I have a bias towards Cleveland-Cliffs and U.S. Steel and Freeport-McMoRan and Nucor and Vale. Not so much ArcelorMittal. So if we look at these, they're all up. It's a bet on the strength of the economy. So Cleveland-Cliffs sells a lot to the automotive industry. So I would expect to see some short-term weakness if the strikes, go up. If we were to look at cash flow on a quarterly basis from Cleveland-Cliffs, they're paying down their debt. So they bought back a little stock. They paid back some debt. Now, what's interesting is they're just paying it back. They actually borrowed a year ago. And so, yeah, they borrowed in 2020. It's good they're paying back. Got to pay it back. Pay back the debt, right? Who wants to hold on to that? Investing cash flow. They are investing in their business every year, thankfully. From an operating cash flow perspective, now this gets interesting because where's the cash? That's not relevant. I don't care about deferred tax. Changes in working capital. So they generated some money from changes in working capital, and they generated some money from actually earning money. No, operating gains and losses actually, I don't know. Looks like they made money the last 2 years, and which is great because the price of steel has gone up just a tiny bit. Their working capital improved a little after having a terrible performance. This isn't really a story of, hey, I'm out of the woods, but it's interesting. U.S. Steel, acquisition target, copper. Copper looks good. Arc furnaces, Vale is the big miner. So international paper could be interesting. If they're making enough profit to pay back the dividend, then that could be a good one. Goodyear Tire and Rubber is a tougher story. They're basically at a standstill from an earnings perspective. They don't pay a dividend. WeWork, they've been very much trying to rebuild their company. The company used to be valued much higher. It has been a really sad story for the past year. It's a lot of bag holders. What's interesting about this is it still could be a relatively good business. We take a look at their financials. I don't know if they're even generating any cash. So we look at a quarterly basis, cash flow. These guys are solidly negative cash flow. And they've been borrowing money. That stinks. So here's a company that loses money on operations, is investing in their business, has to borrow money, and let's be honest, now's not the time you want to be borrowing money. Interest rates are rising. So we look at the income statement. Interest expense. Look at that. For the year, interest expense, $330 million, $450 million, $520 million. I'm just saying, that's a tough business model. WeWork goes bankrupt. WE doesn't make it at the same trajectory. We're not touching it. ARM, I don't really care. It's too technical. Klaviyo, I don't really care. It's brand new. Pinterest, I don't like it because I don't use it. I don't really understand why you would want to post drunk pictures and non-professional pictures. How's that a business? Nope. So I'm back to Goodyear Tire and Rubber, International Paper. One pays a dividend, makes a profit, one does not. That's interesting to us. So I've been talking to you guys a long time. What do you think? Is this helpful? Do you like it? Talked about P&M Resources. Oh, it's up 0.9%. It's a big day. Look at that. Actually, it is a big day. That isn't normal. It's climbing. P&M Resources is climbing. It is a leptokurtic stock that is bumping up against its leptokurtic limits, its low variance limits. And so it's worth a convo. We did publish that it was leptokurtic. Maybe we attracted attention to it. I don't know. I don't think we're that important. Could be. Sure hope people would buy our run, and then I would feel important because I'd be making a profit doing the runs. So we look at Block. Block is down. Block continues to fall. I'm guessing there's something going on right now with e-commerce. AppLovin is down a little. AppLovin's an interesting stock because it has gone through the roof. It was down at like $10. And when I look at the financials of AppLovin, what do I see? What do I see? So I look at it on an annual basis. Income statement. So the revenue is nice. Revenue grew from 2020 to 2021. That's been flat. Cost of revenue's gone up. Gross profit's gone down. Operating expense been pretty flat. So they're losing money. But that doesn't say much because they might have like amortization and stuff. They might have a bunch of stuff. So interest expense is interesting. It was 78 million, 103 million, 170 million. So the interest expense on this company is going up, up, up. So how about the cash flow? So loses money, not growing, higher interest expense. So where's operating cash flow solidly positive for these guys? They make money on their business. From an investing perspective, though, net purchases of businesses, they bought businesses. They bought them every year, it looks like. That's fine. Financing. Common stock. So they issued 1.7 billion in common stock, and it looks like they bought back $1 billion. Debt. Looks like they're paying about 50, 60 million in debt. Looks like they paid some back in 2021, but they issued a lot. So they issued 2.3 billion. They paid back. So they borrowed 1.6. That's fine. So I don't know. Looks like they're going to be owing a lot of interest. Balance sheet. How much do they owe anyway? Quarterly balance sheet. Total debt 3.2 billion, 3.3 billion. Okay. Okay. Is what it is. Is what it is. So this one I see higher interest rates. If they can turn around the business, that's great. If they can't monetize their business and make a lot of profit, this one also could be in trouble because of the money they owe. Don't know. Digital Turbine, we talked about that. Not really making money. Unity, there's a big feud going on right now at Unity. So what I'm going to be doing, because I lowered the price of the run, is I'm creating a very standard report. And then this report is going to have little sections that talk about what you do with the data. So I'm still working on that report because I want to make sure you guys get something you can use for $100, longs and shorts. And I'm also going to be doing some back testing. I know the model works. I followed it for a long time, but you should probably have some data that convinces you that it works. And we'll do that. And yeah, here we go. So it's interesting that the market looked like it was going to go higher today, and we're not sure. Let's go back to some of the data. What do we have here? Do we have any good market data? I can show you my emails. That's interesting. That's actually not that interesting. Did I just shut it down? No, there it is. The Fed. You know the Fed's coming out today. Soon. Very soon. Fed's going to come out and tell us all about interest rates. Today's markets. Here we go. So, getting back to business. The 10-year has come down a bit. You can see U.S. Treasuries are up 0.3%. So, longer interest rates have gone down. People are betting that the Fed is going to be aggressive, hawkish, not raise rates in the short term, but be hawkish. And so that's going to keep people feeling like inflation's dropping. But what I don't know is, are they really going to hawkishly raise rates? Now, you look at the euro. Euro's up to $1.07. They were talking about whether it's going to hit parity. So, I don't know. It's interesting. So the euro is pulling ahead. The dollar is weaker today. Interest rates weaker today. Market higher today, with the exception of NASDAQ. So something going on in tech. You can see here that large value is up, mid value, small value. So today is a value stock day. Today people are looking at picking up some bargains and putting them in their portfolio. Not me, not before Federal Open Market Committee. No way. So, all right, we're still looking at the Fed here, 2 hours and 30 minutes to go. 99% that they're going to hold rates steady. All right, thank you for watching. So if you liked the video, go ahead and like it. I actually ask you to go ahead and subscribe to our channel. It's free. And we have like 340 subscribers. It helps us to get the word out. If you subscribe, YouTube will then promote the videos. And you can also get notifications of when we're live or not. And that would be terrific. I'd really appreciate it. So if you like the video, like and subscribe. Drop a comment. You could tell me what you'd want to hear about next time. And we'd be glad to share really whatever you want to learn about. And we'll close it with a thought that NASDAQ is continuing to drop. And so we are. Gasoline at 267. All right. You guys take care. Thanks a lot. Bye-bye.